Hey, it's Peter from Real NOI. I just wanted to explain to you when we talk about, and you'll see in financial world when they're talking about capitalization rates. So, when a bank is trying to put a value on a piece of property, they take what they call the net operating income. So, the net operating income is your gross rents minus your expenses, and that gets you to your net operating income. So the way that investors in real estate and banks put value on property is they take what's called a capitalization rate, and that's going to be the rate of money at the time. So if you have $1 million and you're at a 4% capitalization rate, you take the $1 million and you divide it by 4% and you come up with $25 million. Now, if you have a 5% and $1 million, it's $20 million. So there's a $5 million difference between a 4% and a capitalization rate and a 5% capitalization rate. If you go to a 6% capitalization rate, okay, then it's 6 into $1 million, which is going to be 17 million and change. Okay, so the difference between a 4 and a 5 is 5 million, but a 4 and a 6 is $8 million. When you own that piece of property and the rates change like they did in the last couple of years, and 3 years ago your building was worth $25 million because it was at a 4 cap, and now it's at a 6, or even worse, it's now only worth $17 million. That's money that just came right out of your pocket, except that the building is still performing exactly the same way. It's not really fair to building owners to do their valuations this way. Now, a bank lends you 80% of that number. So at 4%, when you had this $25 million valuation, the bank was going to lend you $17 million. When you go to a 6 cap, well, your building is only worth $17 million. So you took out a loan 5 years later, you're going into refinance, and the bank is telling you you have no equity in your building and you owe to them more than your building is worth. So the only way for you to get a loan is to pay into it. And that's the position that 40% of the multifamily market that's coming up for refinances in because of change in rates. These are situations that Real NOI is looking to fix, because in the end, investors on the other side are only getting a 5% return regardless. Their rate of return doesn't change much over time because the historical rate of return on money is 5%. So if we went to a 5% and we carry that to the front, it fixes both the front problem and the back problem, and everybody's happy, except for a bunch of lenders in the middle who charge fees. But more about that later. Anyway, hope you're having a good day. If you have any more questions, send them in. This is Peter from Real NOI.